Hey everyone, Chris Lopez here, and welcome back to another episode. So we are doing another episode regarding taxes because that is such an important thing to understand when it comes to either running your real estate business and also owning rental properties for two reasons. One, if you don't know the rules, you cannot maximize your savings. And also with the big tax law changes back in, I think in 2017 now, a lot of people, myself included, are still learning all the changes on there because it was a massive overhaul. So today I have a special guest to come talk to us about qualified business income and how it relates to real estate investors. And my guest is ScottEstill. Scott, welcome to the show.
Thank you very much. Thank you for having me here.
So I am really glad to have you here, Scott. We've when we first met in person a couple months ago now, we had a really in-depth interesting conversation talking all types of real estate investing and taxes and just really got in the details and weeds on things, which I really enjoy. So I'm going to do you injustice in giving people your background because you've had a successful career. Now you've kind of pivoted to do a lot of speaking and teaching. So I'll let you give a quick rundown on who you are and why you're the man who should be talking to us about QBI.
Well, that's a good question. I mean, with QBI and having to deal with the qualified business income, like you mentioned, that's a new tax law that came out in December of 2017. And so what I've done in my professional career, I was a former IRS senior trial attorney in Chicago and managed to get out of there in 94 and start my law practice in Denver in 95. And for the last, 24 years or so, what I've tried to do is devote my career to education, knowing that there's so much disinformation out there, so much misinformation, and just so many different details that apply to all of us in business or doing real estate investments or what have you, but we don't have the education to be able to navigate the tax game. And so that's where, I've kind of thrown my hat in the ring and said, hey, this is how I'm going to run my career and try to help people out in that direction.
Wonderful. And just kind of help connect the dots here. So the law firm you started here in Denver is actually the one that one of our frequent guests, Peter McFarland, is now a part of. So I know a lot of people like Peter, familiar with his firm, and you guys related through the firm you started, you said 20 years ago?
Well, that was when I came to Denver, but yes, I did start a law firm with Stephanie Long, and she's got her Long & Associates law firm right now, and I had sold my interest out a few years ago because I was just tired of the day-to-day practice. And so somebody like Peter McFarland, if I was going to, refer somebody in Colorado for this type of planning, real estate or what have you, that's where I would send the person. I'm not accepting clients now. That's not what I'm looking to do here. It's education, but if I needed the legal help, I would go to Peter for sure.
Great. All right, Scott, so dive into this. I'm just really interested to know about this because I think there's some money I can be saving on my taxes.
Well, the qualified business income, like I said, this is a brand new area. And when you think about where we are with this came out in December of 2017. And so we have this brand new, this Section 199A. And yes, it's quite complex. The whole bill was 429 pages long of just this one section. So the complexity's there, and I think, the problem that we have as tax professionals is that the 2018 tax returns were the first time that the Section 199A was going to pop up anywhere. And we did those 18 returns sometime hopefully in 2019 and got them filed on time. But if those returns are going to get audited, it's going to happen in 2020 or 21. And if they go to court, we're going to get decisions in 21, 22, 23. So several years out before we really know how the law is going to be interpreted, at least to some of these sections. So, let's take a look, I think, at this 199A and just understand the first thing is that it only applies to flow-through entities, meaning that if you have a C corporation, this does not apply. Also, if you're an employee and you're getting paid wages, this does not apply. So on this particular slide, we have to look at the left column and see that these are the eligible entities. So we have some trusts and estates, individuals. So if you own rental property and you report this on Schedule E, this will apply, or Schedule C as a sole proprietor. basically S corporations, LLCs, partnerships, and what have you, those will all apply as well. So let's look at this QBI and just see what precisely it is. First thing is that it gives us a maximum 20% deduction. So what this means is that we can take 20% off of our business income and get a tax deduction for it and not have to pay any income tax on that amount. And starting out here, we're trying to figure out what all this means. I like to go through a series of questions, and let's see what the answers are to these questions to determine if you even get this QBI or you get this tax deduction. So question number one starts off with, do you even have QBI? Do you have qualified business income? So this is an S corporation, it's an LLC, it's a partnership, it's a sole proprietorship, but something that is some income that's going to come from a trade or business. Question two is that once we decide, yes, we do have the QBI, then we've got to decide how much is our income. And the first question here, single versus married, is our taxable income, this is not our gross income, but is our taxable income more than 160 grand, that 16700, or if we're married filing jointly, we can double that to 321.4. And so if the answer to this question is no, that we don't have high income, then we just take our income from the business, multiply it by 20%, and we get this tax deduction. So it works out kind of very, very clean if we look at this next example. And in this example here, the net profit, the K1 there, let's say came from my S corporation. And that could be anything. It could be a law practice. It could be a grocery store. It could be whatever, a plumbing business, real estate, whatever it is. So I maybe made, let's say, $500,000. I took out my expenses, and the net profit on the K1 comes out to this $100,000. The other $45,000 would be, let's say, some wages or dividends or capital gains or what have you. So in this particular case, I have this 145 grand of taxable income, and I look at my net profit on my K1, which was $100,000. I get a 20% or $20,000 tax deduction here. And for those of us in Colorado, you can see that just using this QBI here, and you look at federal and state, it's going to save us about $5,700 in tax.
So I get a few questions here on that example, Scott. So got a couple. So starting off with, so the qualified business income, and I'm going to ask some selfish questions here. So my income as a real estate agent would qualify, correct?
Correct, yeah, as long as you're not an employee. So
okay.
So yeah, if you're an independent contractor, you run your own business, what have you, 1099 worker, yes.
Okay. And then if I own my rental properties, that would count as well.
Yes, and we're going to talk about that actually in a few slides, because that was one of the big problems with this QBI is we didn't know how it was going to apply to those of us who have rental real estate.
Okay, good. So that makes me happy. So the question on this S Corp here, because this is, I love S corporations, and just to make sure I understand the math here. So you're saying you're taking the 20% deduction on the net profit, which is the money left over after I pay all my expenses, including my salary expenses and my dividend expenses.
Yes on the first part, no on the second part. So,
Okay.
So what we're looking at, let's say that we have $200,000 of income and we have $100,000 of expenses. Those expenses would include your salary. They would include your automobile, travel, meals, all the other stuff that you would have. Would not include, though, any distributions from the S Corp.
Really?
So we don't have to factor that part into coming to the net profit line.
Because that's a good thing, right? I'm trying to do that's
yeah.
really, because you're basically
Yes.
you're getting the distributions without having to pay the self-employment income, and then plus you're getting to take a 20% deduction off of that.
Precisely.
So this
yes.
makes the S Corp even better.
Yes, yeah,
Wow, okay.
absolutely it does, because you still have this wage issue here where, and we'll talk about this in a little while, is just because it's better for us in this instance not to take wages or to take a really low amount of wages, the law still requires us to take a reasonable amount of wages. So, you tell me what's reasonable, and there isn't really a bright line test. But
You're the lawyer. You tell me reason. That's one of your guys' favorite words.
Yeah, precisely. Lawyers like us throw around reasonable all the time. What's reasonable, and what's reasonable to you, and what's reasonable to me, and maybe even more importantly, what's reasonable to the IRS. Maybe three different things.
Okay, great. Thank you. So I'm up to speed now. This is good stuff.
Yeah. So in this case again, we could plan for using this QBI, getting our $5,700 worth of tax deductions, and just taking it from there. But again, the last slide assumed that we had this quote unquote low income. Low income meaning it was less than the 160 or the 321 that's up on the screen now. Understand, too, that these numbers are all for 2019, and so for 2020, we'll see a little uptick on some of those numbers as well as they adjust for inflation. But the theory is going to be the same, just the numbers may be changed. But if we look at this slide here and we say, yes, I do have this high income, more than that 160 or the 321, so then question 3 becomes, yes, you have high income. Do you have really high income? In other words, and for tax purposes, $50,000 more for single or $100,000 more for married filing joint. So instead of 160, we're up to 210. Instead of 321, we're up to the 421 number. And the question there is, do we have more than these two numbers, for single or married? If the answer is yes, then our deduction could be totally eliminated or certainly reduced. If the answer is no and we fall in between those two numbers, the 321 and the 421, then we're not going to get 20%, but we're going to get a reduced amount. So maybe 18, maybe 15%, but something less than 20. So again, we have to look now at the high income folks, and whether you think this is high income or whether I do really doesn't matter. It's what the tax law says.
Yeah, that's what Uncle Sam says.
Yeah, exactly. So we're stuck with this, whether, high income. But let's take a look at this person here. Same situation, K1, we have this S corporation. But when you put together the profits and the other income, and in that gray little box there, we have $245,000, which under my math is higher than the 210,700, right? So we're now into this quote-unquote high-income situation. We look at the 20% deduction on the K1, and we're going to get a $40,000 tax deduction. But the problem here is that since we have this quote-unquote high income, we also have to pay wages. And in this particular case, for whatever reason, this taxpayer said, I'm not paying wages. So 50% of the zero, unfortunately, is zero, and you get the lesser of the two. So even though this person had a $200,000 net profit and could have gotten up to a $40,000 deduction, they get nothing because they didn't pay any wages.
So why do you have 50% of wages in there? What does that come into play for?
Yeah, so that comes into play for the high income folks. And so our normal rule is 20% deduction, but once you kick it over these phase-in amounts, and now we get into this high income, you now have to get into a wage issue. And so, we go back to this slide, and this person is totally getting penalized because they have this high income, but yet they paid themselves no wages. And of course, one reason why this taxpayer maybe didn't want to pay wages is because what you mentioned before, right? You have employment taxes on that, and you have this 15.3% employment tax that comes into play on wages. So in this case, they may say, well, look, I'm just not going to pay wages. I'll avoid the employment taxes. And assuming that that's okay under the tax law, that it was reasonable not to pay any wages, this person just eliminated themselves from the QBI deduction.
Gotcha.
Okay. Now let's look at the same situation. We have this $245,000 taxable income. We go to the next slide and we keep that same taxable income. And so I haven't changed my income tax from this slide or the previous slide. Either way, my taxable income is $245,000. But if we go back to the prior slide, my profit was $200,000 from my business, whatever that S corp happens to do. What happens if I take that profit and instead of making it $200,000, I make it $150,000, and then I pay $50,000 of wages? By doing that, I still get the 20% QBI deduction, so that's 20% of $150,000, so now it's $30,000, or I get 50% of my wages, which in this case is $25,000. I get the lower of the two, and I get this tax deduction on 25 grand, or in this case, a little over 9,000, 9,100 or so in change of tax savings. And so I go back again to this slide, and I get nothing as far as tax savings go. I go to this slide, and my income tax bill just dropped $9,100.
So for the high income earners out there, you get the lesser of either the 20% reduction or what is equal to 50% of your wages to yourself.
That's correct.
Interesting. And
That's
that
correct.
never phases out, though. Is that just...
Correct.
Okay.
On this, that's not going to phase out as long as we don't have what's called a service business, and I'll get into that because, like I said, with the complexity here, we have exceptions to the exception to the exceptions and all these different hurdles that you have to jump through. But in general, that's going to be the case. And so, I think you can see here that this becomes pretty much a math problem in that you have to compute what the employment taxes are on this $50,000 of wages, figure that out, figure out the tax deductions that go with the payroll taxes, and then plug that into different formulas. So, in this particular situation, would it be better for this person to claim $60,000 of wages and make it 140 of a K1, or 20,000 of wages and 180? So you can look at all the different combinations there of how you want to take your net profit to see which one will produce the biggest savings, I guess, when you factor all this stuff in.
So I got kind of a side question here, and if this is too much of a rabbit's hole, you can tell me to punt it. But yeah, I mean, I could see, hey, if you pay yourself zero wages, you might save up more money. But like, I can't think of many situations where you can legitimately say, yeah, I paid myself zero wages. I'm dividending myself out $100,000 because in one of my old S corps, I did that for a year and kind of just not knowing because like, oh, cool, I'll save money this way. My CPA was really unhappy with me the following year and so yeah, basically don't do that crap again. And everyone I've talked to since then says like, yeah, reasonable is above zero.
Well, and I think that's a problem. We go back to this slide here where this guy did pay no wages here. This guy gets audited by the IRS, and what's his justification? The IRS is going to say, hey, you made $200,000 a profit. We think your wages should be $200,000, right? Let's just take it to the extreme. And our guy comes back and says, well, they should be zero. Our guy has to be able to support that some way. And, some of the things that I've seen, if you need to, you're starting out the business, maybe your cash flow's a little light, or you need the $200,000 profit to be able to plow back into the business, maybe to buy equipment or do whatever you're doing in the business. But I think the problem comes in here is if they do take a distribution.
Okay.
So in this case, $200,000 stays in. They take no distribution. They just use the money for future, business expansion. We can probably make that argument and get it to go through for a year or two. But now the same taxpayer takes $100,000 in distribution and says they needed the money for future capital. Like, well, you took $100,000 out. Certainly, some of that distribution should have been wages for services rendered. Now, some of the $100,000 distribution could be for a return on as a profit too, as an investor. But again, not taking any wages in a situation where you take distributions. If you get audited, I think I'd rather represent the IRS, because you're gonna have a hard time, as a taxpayer there being able to justify it.
Okay, that makes sense. Thanks.
And then if you go into this slide here, you still could have the same problem here, in that we're taking $50,000 of wages. Is that quote unquote reasonable? And when you look at reasonableness with wages, you have to look at what is the person doing to earn the money, what kind of education, what kind of experience, what's the geographic locale sort of pay grade, that sort of thing. And, an example that I use is that I just passed the bar exam yesterday. Today's my first day of practicing law here in Denver, and I'm charging whatever it is I'm charging. Presumably that same situation now that I've been practicing for 30 years, doing the same type of practice, I'm going to make more money, presumably from my experience. So there's a lot of different things you can do to put in for the reasonableness of wages. Just understand that simply, like in this example, simply because I took $50,000 of wages doesn't mean that that's reasonable. Okay, and I think that's going to be important from an audit, that if you do get audited, you got to be able to back that up. Okay. So the one question that you mentioned before is, does that 20% I automatically get it? And like most tax questions that are out there, the answer is kind of maybe it depends, right? And as lawyers, we don't like to say, yes, you can do that or no, you can't and give this definitive answer, but rather we give this gray area. And part of the gray area pops into question 4 here, and that is, now we look at the type of business, and is this business what's called a personal service business or a personal service corporation? Because if it is, we have different rules that apply. So if I go back and I'm operating my restaurant or whatever it happens to be, that's not a personal service business, and all the stuff that we mentioned on the last few slides applies. But the question now becomes, what happens if we are? So my practice, a law practice, would fit in. Doctors, medical professionals, performing artists, consultants. You can kind of see the list here of these different businesses that fit in. And the one question I had out of this is, you get into consulting, financial brokerage services, whatever, how does that play in with investment real estate? And so I looked at these regulations, and the regulations on this particular section, I think they run about almost 230 or 40 pages. So if you go to the regulations for this section 199A, you're going to have about 240 pages of legalese to read. And the last bullet point is the one that we really need for here, and that basically answers the question that, yes, if you're doing this real estate, you're managing real property, rentals, what have you, you are not considered to be a personal service business, which is good, because there's more restrictions on the personal service businesses. Okay, so we're good here as far as the real estate investors go. So we still have to then be able to answer the question of, what if we do? And so let's take my instance here where I have a law practice. I also have rental properties, real estate, whatever, and doing a lot of different real estate investment. I need to watch what I'm doing, because my personal service business, my law practice says, look, that 20% deduction doesn't apply to you. And so, of course, I'm not terribly happy when I first read that. And if you don't like the tax law, you really need to look at, is there an exception? Is there a loophole? Is there some way around it? And the exception here is that we still have these same numbers that we've been seeing all along, this 160,700, or doubled that to the 321,400. We still have both of these amounts, and if as a lawyer and I'm single, I can keep my income under this 160,700 number, I get the full 20% deduction. Okay, even though I have a personal service business.
Huh.
Okay, and then let's say that my wife and I file a joint return and our income is $300,000. We're going to get the full 20% tax deduction. Okay, the problem comes in here when our amounts exceed the 210 or the 421. In the previous examples, and again, I'll go back to the restaurant, or let's say a 7-Eleven convenience store or something, my income is $1 million. I can still get the deduction, but I just have to look at the wages. In a service business, once my income goes over this 421, or half of that if I'm just single, I lose the deduction in full. And if my income is somewhere between the 321 and the 421, I'm going to get a reduced amount, not 20%, something between 0 and 20%. So this is a huge difference between service businesses and just regular, I guess, non-service businesses, for the lack of a better way to put it.
So I got a question here for you, Scott, regarding this, because I started, a few months after the law was passed in 2017, I started, Googling it and trying to just understand basics of it. And as I was researching QBI, I remember there was a lot of, I'll say, debate online about whether realtors or real estate agents fall within that personal service business or not. Because, from a high-level overview, it seems like us as agents would, because usually, you're the reason, I'm the reason there is a business, and vice versa. But then I remember seeing something from the National Association of Realtors, which is a huge lobbying arm, said they got the realtors excluded from that personal service
Correct.
qualification?
Correct. And I think you hit the nail on the head right there. What kind of a lobby do they have? How many real estate agents are there in the country? How many people in general have real estate? as part of their portfolio, whether it's just a primary residence or whether it's, second homes or rentals or whatever. But yeah, the lobby was very good, and we've been able to exclude out the real estate agents, brokers, what have you, from this.
Interesting.
So yeah, it works out really well. I wish you could have excluded lawyers too, because it would have helped me out as well. But I think Congress was really looking at businesses that really rely on one person. And so you're going to the doctor, you're going to an attorney, you're going to your accountant. They perform a service, you pay them, and that's it. I think the real estate, you get into some different issues there. But again, the lobby was good.
Yeah, I mean, if I had to categorize, I would categorize as a personal service business. But I mean, I'll take the exception.
Yeah, absolutely.
I'll still take it.
Yeah, and we don't know how this is all going to play out either. I mean, remember too that these are the current laws, and it's very possible that in 2020 or 21 or 22 we get a new Congress and they decide that this personal service stuff is going to change, and other businesses are going to be put in it or excluded from it, or these 421 number, it could go down to 100,000 or go up to 1 million. So all of this is very much a work in progress, and I think if we just understand the basic nuances of it and how we can qualify under today's law, we'll worry about what the courts are going to do down the road or what Congress is going to do or what the president is going to do, in 5 years. There's nothing we can do about that now. So anyways, let's take a look at this slide as far as the chart goes. And I put a few charts in this presentation just because I like to be able to look at the charts and be able to flow chart it. And so if we start over in the left-hand side there in that purplish colored box there, and the first question is, do we have a service business? And so I'm going to use my law practice and say yes. And so I go down and then I say, is my income over this? And it says $315,000. That was last year. And so in that little green box at the bottom, I've put in there that the number really is $321,450. But let's assume that my answer is no, that I'm married and my income is $250,000. I go over to the green box and I get the full 20% deduction. But let's assume that it is over that threshold. And so now I go down to the yellow box and we need to find out, is the amount more than the phase-in? And if the answer is yes, I make more than that $421,500 amount, then I get no deduction. If it's no, it's somewhere in between the $321 and $421, then I go to that brown box and I get a reduced deduction. Okay, and that's just a service business. Now let's assume that we don't have a service business. So we're a real estate agent, we're the 7-Eleven owner, whatever. So we answer the box in the top left, the purple one, is no. So we go over to the right to another purple box, and we look and say, all right, is our income under these amounts again? Just the same box really as we had over on the left side. And so by looking at that box, now we can say, all right, no, it's not under that. So I go to the green, and I get my full 20%. Is it over the full phase-in amount? If it's no, I'm over to the brown box, and I get something less than 20%. If my income is high, and that was our high income case with the wages, then I go down to the brown box, and I've got to take now that W-2 wages to come into play. And so, again, this sort of flow charts as to how we can get to a place of hopefully anything but that left box down at the bottom, the little stop sign box that says no deduction. So pretty much the green or the brown boxes is where we need to be and where we need to get to. So if that all makes sense.
Yeah, that makes sense. And just as a note here, I know we got a lot of people that listen to the audio version of this presentation. So, if you want to see the chart, go to the show notes and there'll be a link to the video. And I'll see if I can put up a screenshot of this chart as well. But it's really just a very good visual that Scott put together. They just spent the last 15 minutes walking us through these examples on. So if you follow the gist, you get it. And I don't worry about the details, understand the concept, and make sure you talk to your accountant about it at the end of the year.
I think that's a really good point. I mean, the questions that I've been asking, do you even have this income, and if so, do you have high income and whatever? Those are basically just questions that I pulled off the chart. But I think your point about asking your accountant, I mean, this particular stuff when you're getting into the QBI and what have you, you're getting into a more complicated area because not only are you dealing with QBI, but now you're dealing with typically business entity structuring as well. So in order to get to the QBI, you probably want an LLC, or you probably want an S corporation, or some sort of a structure. So I think even more so than in the past, make sure that your tax professional understands what it is that you're trying to do. Make sure that he or she is like really well versed on the business law, the QBI, and maybe even more importantly, how that all relates to us as real estate investors. I think that's going to be real key right now. And again, for you that are not being able to see the next slide here, if you're not looking at the visual part of this, I've just put in the threshold amounts as to where they are today. So again, if you're married filing jointly, you make under that 321,450, you're going to get the 20% deduction whether you have a service business or not. And then the phase-in amounts, again, they go up a little bit over there just to show you the range of where you could start having some problems in this area.
So I got just a kind of a random question here for you. So is this your overall taxable income, or is this taxable income from that one entity? So if I've got three S corps and each make $200,000 a year and I'm a married person, does it go by the individual one or the total?
Yeah, unfortunately, it would be nice if it went by the individual, but it goes by the total there.
Okay.
So in this case, I look at my taxable income of $321,450. So I could have two S corps, each producing 400, or let's say each producing 200K of income. So I've got 400,000 from my S corps coming in. And if I can have losses, or let's say itemized deductions, maybe on my mortgage interest or taxes or charity or whatever, can get that 400,000 under 321. So let's say I have 80,000 of deductions and it gets it to 320, I'm going to get the 20% deduction on my full 400. Okay, so the key to this part here is not only what's the K1 amount to determine what I get 20% of, but what's my taxable income. And you get to the taxable income a lot of different ways.
Yeah, this becomes quite the game as you get into the details on this.
Well, and that's just it. I mean, it is a big tax game in the sense that we're playing with a lot of accounting, a lot of math, and whatever. But I think understanding though that the game is being played with our money. And so
said.
So it's not monopoly or anything. This is our money, and so hey, if we got if I have a $300,000 K1. And let's just assume that there was no other income, no deduction. So that's my total income. And my wife and I, that's our total income is the 300. I'm going to get a 20% deduction or 60K off of that. And I'm going to save, whatever, 12, 15, 18,000, whatever my bracket happens to be on that. And so, yeah, it's a game in the sense that, if I would have set my business up as a C corporation, I get nothing. If I set it up as an S corporation, I get the 20% QBI. So it makes a huge difference, not only in the past how you were structured, but definitely beginning in 18 and going forward into 19, 20, 21. All those years, your structure is going to have a huge impact on what your overall tax bill is going to be, good, bad, or indifferent. So something to, again, think about. And again, I think you're right, as far as we're looking at the big picture here. We're not necessarily trying to memorize all these numbers. And if I'm giving a talk and I don't have these slides in front of me, I might remember that it's 321 something or something in that range. But the number doesn't really make any difference in the sense of we need to understand the theory. And then the numbers will change each year. We can plug those numbers in with our CPA and work with the planning. But understand the theory. And this slide here, again, this is just one different way of looking at it. Between do we have a service business, yes or no? If no, we're on the left side. If yes, we're on the right. So really no difference in this chart than the other ones that I've used, other than it's just a different way of looking at it. And maybe one way will resonate with you more than others. But going back here, and I think we need to look at how is this going to play for real estate investors. So we've kind of talked about businesses in general, where everything sort of falls, but this Section 199A deduction, first of all, we have to look and see who qualifies. So shareholders of S corps, members of LLCs are going to qualify, and understand too that if you tax your LLC as either a partnership or an S corporation, which you can do, both of those will qualify. If you tax your LLC as a C corporation, which you are permitted to do, that will take you out of the QBI. So anything that's a C corp does not fit on this particular slide. Shareholders of S corps, partners, members, sole proprietors, stock market traders can qualify for this as well. But again, we don't want to be a C corp if we want the QBI. Okay, so real estate. So in general, you'd have to look at real estate and is it a business or is it not a business? And so is our rental activity a business or not? And before we got into this QBI stuff and before we were kind of looking at all these different rules, we had to look at Section 162. And this is just a really general tax section. It basically says that businesses are permitted to deduct all ordinary and necessary business expenses. It throws in a reasonableness element, but it's a pretty general, vague section. But real estate businesses, you could qualify under this, and you have a profit motive, and we're doing this on a continuous basis, so it's not something we're doing one or 2 days a year. We're doing it relatively regularly, relatively continuously, and we could prove that our real estate rental activity is a business. But we weren't sure exactly how that was all going to play out, especially under the QBI, and especially given that the whole QBI stuff was pretty hard to understand. We didn't know how it was going to be interpreted. So we'd have to go back then and we'd have to look at rental properties from a business perspective. And so we would look at what type of property it is. Is it commercial? Is it residential? How much time are we putting into it? And so, one of my rental properties I probably put in 1 or 2 hours a month. It's a totally passive activity. Fortunately, I'm not doing much, a long-term lease, what have you. So that maybe is a very short time, whereas I could be managing a multi-unit building or something that's going to make me devote a lot more of my time. I have one rental property. I have 50 rental properties. I have 100. So the number of properties we have is certainly going to play in. What sort of terms do we have on the lease? What are we dealing with? Short-term, long-term leases, net leases? How standard are they? What do I have to do? What sort of services do I need to perform under the lease? So we would look at all these factors and determine do we really have a business? And if we do, then does it qualify under the QBI? So you could see, I think, at least when I was looking at this slide and the one right before it, I don't really know what the answer to all this stuff is. And that's really the problem, right? I have one rental property and it's commercial. Does that qualify? What about if I have two? What about if I have one commercial and 3 residentials? And so there was never really a bright line test that would say, if you own X number of properties, you qualify. And so we didn't know what any of these answers were or amount of time devoted. Is 5 hours a week enough? Is it 40? Is it, what's the number? And so since we didn't know that, we kind of thought that the IRS was going to give us some guidance. And typically when the IRS is going to give us guidance, I don't typically like the guidance they give, right? And so the IRS comes out with this regulation, and this regulation, in my opinion, really, really helps us as real estate investors or having real estate enterprises. And the reason for that is that if we go back to the prior slide and we go through all of these different numbers and different sort of questions that we're trying to answer, we still don't come up with a yes or no answer after we get done with this, right? We don't know what the answer is. Now we go to the safe harbor, and as long as we can satisfy all 3 of these bullet points, and notice that after bullet point 2 there's an and in red here, meaning that it's 1, 2, and 3, we can now qualify for the QBI. So what does this all mean? Well, look at the gray there, the gray box there. And again, for those of you that are looking at this, gray box says for each rental real estate enterprise. And so we're going to talk about what that means in a minute here as far as what is a rental real estate enterprise. But we're looking at separate books, we're looking at an hours requirement, and we're looking at a records requirement. And so let's look at and just see what exactly those mean.
And just to clarification, go back. So this is the first bullet point of the 3 bullet points, which reads, separate books and records are maintained to reflect income and expenses for each rental real estate enterprise.
Great, thank you. Yeah, I should have repeated that. But so bullet point 1, separate books and records. We're maintaining them for each rental real estate enterprise. And just to throw a question out to you here, if you're keeping, if you've got rental real estate and whatever, are you keeping track of your income and expenses on that?
Absolutely.
Right. Now let's forget taxes. Just forget that we don't even need it for taxes. Are you still keeping that information?
Yeah.
Yeah, I am too, right?
If you're not, I think it's silly.
Yeah, well, I mean, how do you know in something like that, right? I mean, so you have a rental property here in Denver, and then you have one, let's say, in Colorado Springs. How much rent are you getting? What kind of expenses do you have? What kind of cash flow are you doing? What's your return on investment? All those things, to me as a real estate investor, I want to know, right? I mean, and so I'm going to keep these records even if the tax stuff didn't exist.
I 100% agree.
Right? I mean, so if I know my Denver property is barely cash flowing and is giving me a 1% return on investment, I may want to look at either figuring out a way to boost that or get rid of the property, right? And so I'm going to need to do this anyways. But the tax law here is saying, bullet point 1, you have to do it. And so what are we talking about? Well, let's keep a profit and loss statement, a very fancy way to say income and expenses, right? How much money is coming in rent, how much money is going out in mortgage interest and taxes, utilities, supplies, whatever else you're doing. Balance sheet, it's just simply assets and liabilities. You have a rental property worth $100,000. You have an $80,000 mortgage. I mean, it's basically just putting the assets and the liabilities in the right places. Looking at your bank statements that you get every month, whether you get the physical copy or online, doesn't matter. Let's make sure that the bank statements are jiving with the rest of the info. And any ledgers you're keeping to keep track of the income and expenses.
And probably keeping separate bank accounts for each rental property, I would imagine.
Absolutely.
Or at least have your personal.
Well, at least we want to separate it so that your bank statements. If you have 5 rental properties, you're gonna have one bank statement for yourself and at least one bank statement for the 5 rentals. I would typically have 5 bank statements for the 5 rentals and separate them into separate LLCs for asset protection. But again, you definitely want to separate the personal from the business here. Don't combine the two. So that's bullet point 1. And to me, this is a pretty straightforward one.
Yeah, that's I think an easy one for people to check off the box. And if you can't, this is easy to do.
Well, yeah, and if you can't do this, if you're not keeping these records, you may want to really consider, should you be investing in rental properties to begin with, right?
That's a wonderful point.
So we need to look at it, right? So we're doing this. I mean, let's just say we're doing it, and if we're not doing it, we're going to start today and make sure that we get our house in order here. But bullet point 2, so this one is saying that we have to show 250 or more hours of rental services with respect to each rental enterprise that we do. And this is where rental enterprise is going to come in, because how many of us are spending 250 hours or more on one rental property? Now, you look at that's 5 hours a week. For single-family residences, most of the time, let's put it this way, I've never spent 250 hours in 1 year on one single-family property.
If you are, you should hire a property manager because you're
something's wrong.
Doing something wrong there.
Something's wrong or whatever. Or, maybe the one property happens to be a 200-unit condo complex or apartment building or something. So, I mean, it is possible, but for most of us, that's not going to happen. And so we'll look at these rental enterprises, and we'll probably end up grouping them. So we have 5 rental properties. If we do 250 hours on all 5 of those combined, we're good to go. Now, a couple points on this one. The 250 hours can be done by pretty much anyone. So they can be done by us as owners or as members or shareholders or partners or whatever. They can be done by employees. They can be done by our agents or independent contractors. So let's say in one of my properties, I've got to do some renovations in it and it's going to take 25 hours. I can manage an independent contractor to come in and do the work, and the independent contractor's time will count in my 250 hours.
Interesting.
Okay, so you can lump this all together. I would say, though, and this is one caveat that I always will use with hours, and you see this with 250 hours here. You see it for those of us that are listening that qualify as real estate professionals, where there's a 750-hour requirement. But if we can do and satisfy those hours, make sure that, one, you're keeping track of your time. So it's up to you. If we go into an audit here, it's up to you to show the IRS that you worked more than, let's say, 251 hours or more. The second thing is, not only do we have the burden of proof, but understand that don't come in with 251 hours, right? The reason for that is that the IRS could go through there and decide, we're not going to give you these 2 hours, and now you're at 249, and now you lose this exception. So we don't want to see 250. Come in with 300, 350, 400, whatever it realistically is, but you got to keep track of the time there. Okay, and I think that's critical. A lot of people just think, well, of course I'm doing more than 250 hours. That's a no-brainer. But you go into an audit and you tell the auditor that, you may not like the results, right?
So if make sure to understand, so I have a property manager that manages my properties, and I put in, 30 hours a year managing the property manager, but the property manager puts in 300 hours managing my, eventual retirement of a 100-unit apartment building. That 300 hours they put in counts to my 250-hour threshold.
Correct.
Okay,
Correct.
That's cool.
For purposes of the QBI, and if we go back, and this is a whole new, whole nother presentation on real estate professionals, but that same 300 hours would not count for the 750 for real estate professional status. So again, I'm mixing two separate things here, but understand that some hours will count for one, they may not count for the other, but we just got to get over this hurdle.
Makes sense. Okay. So that's bullet point number 2.
That's
250 hours
Correct.
or more.
And now we have to look at number 3. And what number 3 is a contemporaneous issue. And what we're talking about here is that you've got to keep contemporaneous records of any of the time reports or logs or any of the records you're keeping as far as what you're doing with your real estate enterprise. So contemporaneous just meaning, hey, let's write this stuff down now. Let's not, wait for April 15th and then go back to the prior year and try to fill in all this stuff. So if I spend 3 hours today doing something for my real estate enterprise, and I'll show you what hours qualify and what don't in a minute here, but I put down the 3 hours there, I'm going to describe what I'm doing. I'm reviewing leases for 3 rental properties in Fort Collins, Colorado. I'm putting the date in there. It's on my calendar or it's in Office or wherever it is. I'm keeping that online. And then who performed the services. So you could see something like today could take me 15 seconds to write this down. Scott did 3 hours of reviewing leases in Fort Collins on September 20th or whatever the day is. And right there, I've just locked in my 3 hours. I've satisfied the contemporaneous records. I've satisfied the 250 hours. At least I'm getting towards that. And I'm working on my real estate. Okay, so again, keep the records timely. And we want to do this even forgetting the tax stuff here. So forget that even this rule exists. I don't want to be waiting a year to be writing down stuff. For instance, today, whatever my mileage was to get over here to record this, if I wait a year, I won't remember what I did.
Geez, you wait a week, you won't remember.
Hey, I won't remember if I look at it tomorrow, if I don't write this tonight. But the point is that it's a habit, it's a mindset, and just get in the habit and the mindset of writing this stuff down, when you're doing it. You won't miss anything, and you'll preserve the tax deduction. So let's keep it going here. So the question then, when you look at the 250 hours, is what are rental services? And fortunately, the IRS, this list here is not from me. It's from the IRS. But the IRS is telling us that these particular things qualify as part of the 250 hours. So if you go out and you advertise your apartment to lease it, that is part of the time. Of course, you negotiate, you execute some leases. You've got to review the leases. You've got to review your applications. Is this prospective tenant? Is this a good tenant? Is they likely to, pay the rent timely? What have you? What do you have to do to collect the rent? What do you have to do to maintain the businesses on a daily basis? So that's operating the business, repair, renovation, managing the real estate, purchasing any supplies or materials, actually doing the renovations or the repairs, or supervising somebody to do those renovations or repairs. And again, all of these different activities, these quote-unquote rental services, can all be done by somebody else. So if you want to have the rent collected by a property manager, which I do on actually all of my rental properties now, I'm not collecting any of the rent. The time that they're spending doing that goes into the 250 hours. Okay, so any of this stuff is going to apply, any combination, but the one key point here is that you better write this stuff down. So if you were negotiating a lease today, I would put that somewhere in my planner that I was negotiating a lease at 123 Main Street in Denver, Colorado with, potential tenant, Joe Smith or whatever it happens to be. So document this stuff, document. Okay? And so this is what real estate investors can use for rental services. What we can't use for rental services is up on this slide. And what the common theme here, I think, is going to be more investment related or financial related. So even though arranging financing and studying and reviewing financial statements on the operations, all of that's important to running a rental enterprise, it's really relating to investment type activities. And so investment management and a lot of things to do with money are not going to count for rental services. The last bullet point was one I didn't like to see in here, and this is one I didn't think was going to end up here, but did. And again, nobody cares what I think. It's what the law thinks. And so the hours that we spent, the time we spent traveling to and from the real estate cannot be used for purposes of the 250 hours.
Yeah, that's a bummer.
Okay? Yeah, that's a bummer as far as, fortunately that's not going to apply to real estate agents, that are going out and listing the properties and showing them and whatever. But for these rental services, if I've got let's say I do an hour round trip to get out to one of my rental properties, that time I can't use anymore, even though it may be totally necessary for me to go out there and do it.
So you can't use that time to count towards the QBI qualification, but kind of shifting tax things, you can still write off the mileage to deduct from your rental income business, right?
Correct.
Yeah.
That would be right. So just for example,
still track it.
Yeah, definitely. You drive 100 miles, you're taking the standard mileage rate, you're going to get a $58 deduction for it. It just means that the hour you spent driving that 100 miles doesn't count for time purposes.
Is it up to 58 cents a mile now?
It is 58 cents a mile this year.
Wow, okay. I'm still using like 53.5 mentally.
Yeah, well, mentally, we got to get you into 2019.
Well, I just track my mileage and let my CPA figure it out later.
And that's what that's the easiest way to do it, right? Track your mileage, and you may have to down the road get a reimbursement if you're getting it from a company, and then, for instance, one of my S corporations will reimburse me the 58 cents, but either way, that's an example of the numbers really aren't terribly relevant here. It's the thought. So As long as when I'm driving for business, whether it's for my rental property or whether it's, for somebody like me that's driving to court or whatever, that time may or may not qualify, but the mileage still will. Okay, so real key point there. We still want to track it. One thing to keep in mind when we're filing the tax returns is that if we're going to use the safe harbor, and that's the 250 hours, contemporaneous records, separate books and records, the three things I just mentioned here, we have to attach a statement just saying that we satisfy these three rules. So we're self-certifying basically that we satisfy it. Notice, though, that it's under penalties of perjury, meaning that I know I only had 150 hours, but I'm going to lie and say I have 250 hours. IRS comes back on that and they find out that I'm lying on that. Penalties of perjury means that I've just committed a crime.
And that's a serious crime.
It is a serious crime. It's it's tax evasion here. Yeah. And remember, what we're looking at here and what we teach and what we try to implement is tax avoidance, right? Which is totally legal. Tax evasion, totally illegal. So really big difference. We don't want to go anywhere near getting into lying to the IRS or putting stuff on the tax return that just isn't true, especially considering that we've got all these laws that are set up to help those in business, to help us with our real estate investments. And why don't we just learn the laws and then maximize the laws, right? Take advantage of every last possibility. So safe harbor, we just make sure that we put that on the return. Here, the key part is what is our real estate enterprise. So we either have each rental property qualifying, which I would submit is extremely difficult unless you have some real big units, a lot of different, multi-unit complexes, or we group them all together into a real estate enterprise. We're not going to be able to bounce back and forth year to year. So if we decide to treat them all separately, they're going to be separate. We try to group them, they're going to be grouped that way, and we're just going to have to keep them that way unless there's some real big significant change. And so I wouldn't count on going back and forth or changing them once we set it up. Also, the commercial and residential can't be lumped together. So if I have, let's say, a strip mall, and I also have a couple residential rentals, those are two different enterprises. All right, so lumping them together, we get to decide how this all plays out. And as long as we're not trying to use our primary residence, which is not going to qualify as an investment property, or if we have a triple net lease where we have a tenant's paying all the utilities, insurance, taxes, whatever it happens to be, which again is not going to be the norm. As long as we're not into one of these two situations, we're going to be in a situation that we're eligible at least to use the safe harbor.
And those are fair exemptions. I would agree with that. Your personal residence and triple net leases.
Yeah, exactly. And the other thing too on the primary residence is that we don't really need this stuff. Primary residence, we already get to deduct our interest, at least most of us do, and the real estate taxes are going to come off. And when we go to sell our primary residence, we've got a real big tax benefit of excluding most or all the gain.
Yeah, that's one of the best tax benefits out there.
Absolutely. The best tax shelter for the average American is their primary residence. However you want to look at it, because you're going to get basically $250,000 or $500,000 of capital gains excluded, which is going to cover most houses in the United States. So, yeah, the primary residence we don't really need to worry about. And the triple net, again, we don't see that, or at least I don't see that often. So the question now becomes, yes, we have this income, we have high income, we don't, we're a service business, we're not, we're a real estate investor, not. We've gone through all these questions. Now we have to look at it from a real estate standpoint and say, do we even want to claim the QBI? And this is something that, at first it's counterintuitive. You'd say, well, of course we want to claim the QBI because it's a tax benefit. Why wouldn't we want to claim it? Well, a couple reasons why we may not. The first thing is that when we finance rental property, and let's say it's a residential rental property, we're going to get depreciation on that. And so we're going to get depreciation over, in this case, residential 27 and a half years. And so I can be cash flowing a rental property positive, but yet having a tax loss because of the depreciation.
Mm-hmm.
Okay, and so if I'm in that situation there, I would have a negative income on this rental property business, this enterprise, and this negative income, in this case the negative QBI, would offset some of my positive QBI and reduce the amount of the deduction. Okay, so this gets a little bit complicated.
Really?
So let's take a look at how this could play out. So on number one here on the very beginning, we have a net profit K1/business. This says nothing about real estate, so we'll just use this as my pizzeria. And I make this $150,000. Now my net loss on the rental properties, and I'm electing to group these together for QBI purposes, is a $100,000 loss. So I have 10 rental properties, $10,000 of depreciation, let's say on each one. So I'm cash flowing neutral, but I get this loss. The $100,000 is going to offset $150,000 of my profits for my business. Now my QBI is going to be based on the $50,000 of net profit. 20% of that is going to be deductible. And so in this case, with me lumping my real estate into the QBI, I'm going to get a $10,000 deduction, and depending on what my bracket is or depending on what state I live in, I'm going to get some tax savings. But that's if I decide to do it with QBI in the real estate. What happens if I decide not to take the QBI? So in this instance here, I've got the $150,000 of business income, same business, everything's the same. My real estate is not QBI, and so I get this $100,000 loss. And I'll come back to that loss in a second here because that may or may not apply. But if you look here, I'm not offsetting my $150,000 of QBI income with the loss. And so now I'm getting a full 20% deduction on the full QBI, not considering my rental real estate. And so if you look here, the tax savings become a little bit over $8,500, whereas if I would have elected the QBI situation, I'm going to have less savings. And so here, not electing QBI is going to give me about another $5,700 of tax savings. Okay, and that obviously becomes a real big income tax point. But I want to go back to the last slide here with the one big caveat, and that is that our net loss on the real estate Schedule E, that $100,000, may or may not be tax deductible. And I think that's where the issue is going to come in. So if we go back to the first example where we're using the real estate as QBI, we know we're going to get the loss, and we know what our taxable income is going to be, in this case $95,000. But if we go to this one where I've got this big loss, in order for me to use that $100,000 loss, I have to qualify as a real estate professional.
Yes.
Okay, and that's where the problem comes in. So if we use myself in this particular situation, I'm not going to get the benefit of that $100,000 loss. And in effect, I'm going to get no tax benefit on it. And so my net income here, taxable income, is going to be $195,000 because that $100,000 loss is going to be passive. And the reason I say I don't get it is because I don't qualify as a real estate pro. And so in order to qualify as the real estate pro, that's where the 750-hour rule comes in. Have you guys done any podcasts or anything on the real estate professional?
We actually have. So actually with Peter McFarland, we did a tax series on that a while ago, and he talked about that. So that's a great one to go back and listen to because we dive into details and who can and who cannot qualify for that.
And I think that's a good point. Go back to the one that Peter was doing, because I've done ones on Real Estate Pro, and I know Peter's stuff is always outstanding, but that can be an entire presentation. And so, we're looking at this particular slide as far as some of the planning ones. Number 2 says real estate professional status. Again, definitely go back and review that because there's 3 separate rules that apply for the real estate professional status. And if you don't meet all 3 of those, then we get into this, what bullet point 3 says, and that's this passive activity loss, which basically says that instead of me getting, in our prior example, $100,000 of losses, they would be limited to $25,000. And then, unfortunately, for every $2 that my income goes over $100,000, I lose $1 of that deduction. And so once you hit $150,000 of income, that $25,000 limit goes to 0. And if you're not a real estate professional, you're out.
But if you don't use it, that still carries forward to the next year until you eventually can use it, right?
Correct.
Okay.
Correct. So yeah, you look at these, and these passive activity losses are called PALs, P-A-L.
Is that the cool kid lingo?
Yeah, even though they're not PALs. But the reality is with the PALs here is the first thing we do. Let's say we can't use any of this. So we have a $100,000 loss from our rental properties. We can't use it, and we don't decide that we don't want to use it for QBI. Okay, so we're now looking, and we have to look and say, do we have any other passive income? So maybe I have some other investment, some oil and gas, some other properties, I don't know, whatever it happens to be. If that generates some passive income, I can offset it. But let's say I don't have any of that. I then move my passive income into the next year. So I'd go into 2020 or 2021, and I keep deferring it until I either use it or until I sell the property. And once I sell the property, then I can use up any losses that I couldn't claim before.
Okay.
So it's not a use it or lose it situation. It's a use it or timing type situation. Okay, so I think what I'm trying to get at here with the planning considerations is that you have to look at what's the benefit of any real estate losses. So is it going to be a current benefit? Is it not going to be a current benefit? Is it a current benefit if I use the QBI or I don't use the QBI or what have you? And so that's where you're going to have to plan. You're going to have to run some numbers and make some decisions, quite frankly, with whoever's doing tax planning or at the very least whoever's going to be preparing the returns. And so, I think one of the things to take away from this is that, as the 4th bullet point here says, QBI equals beneficial with net profit. And what I mean by that is that if we have a net profit from our real estate where it's not going to reduce our net profit from other businesses, so let's say we made $10,000 in our real estate enterprise, the QBI becomes more attractive the higher the net profit goes. And so you see this a lot of times with either folks that have already run out of depreciation or maybe those that are buying the property free and clear, right? Or have a very minimal, let's say that they put 80% down, and are taking a 20% note out. So their interest deduction is limited, so their net profit is going up. So you kind of have to look at, who's the investor here? What kind of investments do they have beside this real estate? What's their net income, coming from all different sources? What's their rental properties doing? What's it cash flowing? What's it returning? But then also, what's the net tax effect as well after we factor in not only all the deductions, but the real big one, the depreciation deduction. And then we look at that and say, well, does the rental property enterprise have a profit? If yes, we want to definitely be looking at the QBI, and we're probably going to go that way. If it doesn't have a profit, then we have to see, is it really beneficial to call it QBI, or what if we just don't call it that and run this as just a straight rental property type business? So again, I think this slide pretty well sums it up, I think, in the sense of there's a lot of planning that comes into play. This isn't just something where, yes, my S Corp, my law practice took in $100,000, I'll take 20% of that, I get 20,000, blah, 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 and I'm done with the planning. The rental property stuff has to be coordinated. It has to be worked out not only with other rental properties, but also with other businesses. It has to be tied to your investments, has to be tied to your itemized deductions, and what are you giving to charity this year? And so again, there's not sort of a, this one size fits all type of planning. It's what is it that you're going to do to be able to get you to a place where you're going to be able to maximize all of your tax benefits while still being able to run your business and your rental properties in a tax advantageous way. So anyways, I've put my contact website on the screen here. Again, I'm not looking for clients, but I do a lot of educational stuff. So LinkedIn, I post several times a week on that. And again, if you're looking for an attorney here in Denver that does all of this type of stuff and understands it, I refer business to Peter McFarland, and that's probably where I would go as well. So anyways, that's kind of my presentation. Now, have I totally muddied up the waters on this?
No, you've done a very amazing job of being very clear and presenting this very well in bite-sized pieces, because this is a hard topic, and I wrote down a bunch of questions, and I've learned to save them. Oh, cool. You answer that question, cross off. Answer that question, cross off. So I think you did a wonderful job. And so if you guys want to learn more about Scott or get more of his education, go to www.ScottEstill.com. So SCOTT, the letter ESTILL.com, and that's his website. And I know you're out there a lot of times presenting, doing webinars. You've authored a few books. So you're out there producing some education. So you guys make sure you tap into that, because as you can tell, Scott knows his stuff and he enjoys sharing it. So we appreciate it.
Yeah, thank you very much. It's always my pleasure to try to help people understand what sometimes isn't all that understandable. And hey, if we can do a little bit of planning and keep more of our money for ourselves, that gives us more to do for what we want to do, what our family wants to do, and not what the government wants to do. So thank you for having me.
Great. Well, thank you, Scott. Everyone out there, thank you for listening. If you've got questions and feedback, always reach out. I love hearing them.